Welcome to Wealthion. I'm Wealthion founder Adam Taggart, back here at the end of yet another week with my good friend, portfolio manager Lance Roberts, who's going to make sense of everything that's happening in the markets for us. Hey, Lance, how you doing?
I'm trying to figure it out.
I'm sure you are. Well,
Just like everybody else.
Yeah, we'll figure it out together here. Folks, you may notice I'm in a different background than normal. I'm on the road this week. I'm actually back on the East Coast. So taking time for my travels to make sure that Lance and I get your weekly market recap in this week. Might be a little less structured than normal, might be a little shorter than normal. My apologies for both of that, but we'll still try to make it informative and entertaining. So Lance, to kick things off, up week in the markets here. What do you have to say about that? Market beginning to get a little bit of octane back in it?
Well, no, and again, this is, pretty much exactly kind of what we would expect, and as we talked about, let's go back a few weeks, and we were talking about in July, that the markets were getting extremely overbought and that we would need some sort of correction at that point. 3 to 5 to 10% would be completely normal. And that shouldn't be a surprise to anyone whatsoever. And of course, then in August, we had this bit of a pullback, and everybody's like, oh my gosh, the bear market's back, which, we also said that would be the case, right? The bears would come out and say, see, I told you it was a bear market rally and now it's all over. But the reality is that correction was very much needed. And now we're just going through this very kind of normal process of kind of holding on to previous trends and these type of things. So let me share, if you don't mind, can I share my screen real quick?
Absolutely.
This is a chart of the S&P with a couple of just real simple indicators. The top chart is the MACD. That's kind of our basic, very simplistic, buy, sell, kind of indicator. Now, look, there's if you talk to people that are super adept at technical analysis, there's about 1 billion different technical indicators. I'm not a technical analyst by nature. I'm a fundamental analyst. And so when we do things, we look at fundamentals, we look at valuations, we look at earnings growth, we look at those type of things. We use a very simple overlay of technical analysis just to help provide some risk management to portfolios. So yes, I understand. Don't email me a bunch of these indicators and that indicator. That doesn't matter to me. What I'm looking for is I have a very basic, simple set of tools. I use 3 moving averages, a relative strength index, and a MACD indicator. That's pretty much it in terms of managing portfolios, because all I want to know is our prices trending higher, or are they trending lower, or what's going on? And so if we take a look at the S&P, we've been in a very nice bullish uptrend, really since going back to October of last year, but you can just see this kind of trend channel that's been forming here lately. We got to the top of that trend channel. Every time we get there, we sell off to the bottom of the trend channel, then we rally back up to the top and back down again. And that's all that's going on in the market. So the rally this week, not surprising. We've just been kind of flopping around here for the last couple of weeks. As we talked about earlier, August, September tend to be sloppy trading months. That's exactly what's going on here. That's beginning to work. Some of this previous overbought condition we got oversold, and we're kind of slopping around here. Yesterday was quadruple witching day for options expiration. It was one of the largest on records that we had. And so, volatility here, this whole week is not surprising heading into that options expiration. But this is all setting us up potentially for that end of the year push, which is October, November, December, which typically tends to be more bullish. Does that mean absolutely with 100% that we're going to have a bullish rally into the end of the year? No, that's not what that means. What that means is that seasonally, historically, going back over time, October through basically May, that's the strongest 6 months of the year that we talk about a good bit. That seasonally strong period of time, end of the year into the beginning of next year, is when money flows are coming into the market. Starting in October, you're going to have roughly $5 billion a day in stock buybacks coming into the market. So again, corporations, and this is going to be the mega cap stocks and large cap companies. This won't really affect small and mid cap much because they don't do stock buybacks. But in the large cap end of the index, you're going to have a lot of stock buybacks coming in through the end of the year. You're also going to have portfolio managers chasing performance into year end. They've got to get their performance levels up. If you look at the bifurcation between the S&P and the equal weight index, that there has not been a bunch of return. If you've owned stocks outside of the top 10, we talked about this a bunch, but anything outside the top 10 really hasn't performed well that year. So this year, so if you've had any type of diversification at all, your performance is well below what the S&P index is. Unfortunately, if I'm a large cap manager, I've got to chase the S&P index. So look for some performance chasing into the year end. Got to get that window dressing done by the end of December so that I don't lose my job as a portfolio manager, because there's what's called career risk. So again, right now, what the market's doing exactly as expected, exactly what we've been talking about here. Expect another week or so of kind of sloppy, crappy trading. And then once we get through the Fed meeting next week, which I suspect they're not going to say anything different, that the markets will interpret that the Fed is now done hiking rates, and that potentially sets us up for some better performance heading into year end.
All right. Hey, keep this chart up for a sec, Lance. Sure. So great insights and great commentary as always here. As you may remember, we had Sven Henrik, who does TA for a living, and he does look at the billions of permutations of this.
Yes, he does.
and he, like you, I would say, is quite bearish on a fundamentals basis. But he says, look, the markets trades as the markets trade. And this year, the market has traded extremely well on technical analysis. Technical analysis has had a lot more sort of predictive and explanatory power in, in defining or explaining helping us understand how the market action has happened, way more than the fundamentals. And he's saying, at some point in time, I think the fundamentals will matter, but until they do, we got to trade the way the markets are going here. Right. One chart that he had put up, which he said isn't really even true TA, was just a chart of seasonality in the markets, and it was an average of the previous 20 years of S&P market behavior. And he said that's basically the script the market's been following this year. If it continues to follow it this year, like you said, Lance, he said that the market should finish the year substantially higher. Are you pulling up a link that's related to what I'm saying?
Yes.
Okay. There you go. Thank you. Yes. So look at the end of that, the right end of that chart period, and you see that
sorry, it jumped on me real quick.
No worries. But you see that the market kind of makes a big run there to the end of the year, right? Right. So, that's what Sven is just saying. I'm not saying that's exactly what's going to happen, but be mentally prepared for it, because this market has been following this script all year, right? So if it does, you had that bullish uptrend channel in the previous chart, right? And it looks like were the market to run back to the high end of that channel, we're talking what, like about 4,650, 4,700?
Yeah. 4,600, 4,700 by year end would not be out of the realm of ordinary. Look, there's some companies at Wall Street firms out there going 5,100 by the end of the year. That's probably not the case. There's certainly a possibility that we could hit all-time market highs by the end of the year, depending on how bullish things kind of get. But I think you get to the top of this trend channel by the end of the year, again, 4,650, 4,700, maybe even 4,750. That's probably a reasonable, expectation for the markets between now and year. And remember, if we get back to 4,650, 4,750, the S&P as a index is going to be up over 20% for the year. And that's, pretty amazing coming out of a market last year where you were down 25% at the trough. You're going to have recovered all of that correction last year, this year, which again, that's why last year was a correction. You don't recover a bear market in 1 year. So again, what the market's doing this year is very typical following a correction year like we had last year. And so that's where we are.
Okay. And again, folks, you're not necessarily calling for 4,700 or 4,750 on the S&P, but you're saying the potential for it is certainly possible, and it's really not dismissible. It's almost sort of where the trend is heading. Again, not saying you're calling it there, but if you're a bear, this is what I'm underlying here. If you're a bear, and if you're saying, wow, I distrust this market from a fundamental standpoint, and I want to start positioning against that, maybe aggressively using shorts or whatnot, just be cautious that the momentum right now is not in your favor. And Lance, you mentioned, some calls of like 5,100 or whatnot by end of year. So, for months now, as the market has, been strong this year, I'd say once it sort of passed 4,300, I started getting a lot of comments from people saying, hey, there are a couple people out there who are calling for S&P 6,000, and you got to get them on this channel because here's that melt up that they've been talking about. I just want to ask you, of course, anything's possible, but how realistic do you think, in the next 6 to 9 months, we would see a melt up of that type of magnitude?
Probably to 6,000. That's probably again, you can never say, I'm going to spit this out. So give me just a second. You can never say with certainty that absolutely something is never going to happen, right? That's a very dangerous perception about anything in the markets. There's always possibilities and always probabilities. And so as a portfolio manager, as an investor, you need to assign a probability to even the most outlandish, prediction. Say, okay, I get it, 6,000 in the S&P. No way that'll ever happen. Maybe the case, but we need to give it a 10% weight, that there's certainly something that could happen that would drive stocks to that point. And what would that be? Well, that would be the Fed coming out tomorrow and, saying, we're cutting rates to zero tomorrow, and we're going to start doing 500 billion a month in quantitative easing. That would certainly drive the markets right to, that would be like the next day would be at 6,000. So you've always got to give it a possibility, because we never know what is going to happen, economically. This was last week's article on our website at realinvestmentadvice.com on Tuesday, talking about market predictions. And, you always have to be careful with gurus who say, oh, this is going to happen with certainty by this time next year. We're absolutely going to be here. You can take that and pretty much discount that for all of its worth. Even meteorologists, as we show in the article, are only right for 3 days. At 10 days of weather, and you got to think about the amount of data, real-time data that meteorologists have, right? They have weather patterns, humidity, weather, global temperatures, sea level temperatures, atmospheric pressures. They have all that data to work with, and a bunch of historical data that says, okay, when this environment is correct, this is what's going to generate this weather pattern. They're only at 10 days, they are only 50% correct. So how can you take anybody with all the macro events that we have no control over, economics, politics, geopolitics, just earnings, corporate events, weather events that affect commodity prices, with all that uncertainty, how can you predict anything 12 months in advance? It's just ludicrous. So that's analysis is so very important in the short term, and why we rely so much on it in the course of a week or a month or 3 months, because that's about all it's worth. Technical analysis is only good for a week to a month at the most. Outside of that, it starts even getting really kind of iffy. Trends are important. We can measure trends, we can monitor trends, but again, back to your question, when somebody says, oh, we're going to have this extraneously large move in the markets in one direction or the other, it could be up or down. There's people out there saying, hey, this market's going to be back at 3,800 by next year. Maybe there's certainly the risk of that happening, but we have to assign it a smaller percentage. The probability is markets are going to trade within a given range based on earnings and fundamentals for a period of time, market psychology, liquidity. Those are the things that are going to drive the markets in the short term. And markets are going to basically trend in one direction over time. And generally that trend is bullish. The majority of the time that trend is bullish. The minority of the time that trend is bearish. And you need to keep that within your wheelhouse of measuring kind of market outcomes.
Okay. I'm going to re-ask the question slightly differently, just to get a bead for what I think, the viewers are looking for here, which is, some are saying, oh, these people who've been making these big predictions, hey, yeah, it's taken a while, longer than they thought, but now is the opportunity. And let me just restate what I heard you say, which is like really extreme moves like that don't happen very often. And looking at both the fundamental and the technical, I don't think you see a rationally high probability of a big upside move like that, unless, as you said, there is some unexpected and extraordinarily extreme sort of central planner move, right?
But
could happen.
Right. So I just shifted my chart back in time. just to get to even just help define this point a little bit more, to your question, right? Even with so this is now 2021 through the peak of the market in 2022. Okay, so let's go back to that period of time as a moment. What was going on then? We were doing $120 billion a month in quantitative easing. We had zero interest rates in terms of the Fed. So even with all that, and then also don't forget, we had $5 trillion in stimulus. We had checks going to households. We had
record low interest rates. Yes.
Yeah. So talk about the perfect environment for a market melt up that was just going to be extreme. You can even look at this chart. Yes, we had a very sharp rise in the market. The market went from 3,600 to 4,800 in a year, right? So it was up 22% for the year. That's a fairly strong advance, but look how perfectly flat it was. It wasn't a skyrocket higher, right? Even with all that stimulus and all that support and all that just a tremendous amount of bullishness, the market just kind of ground its way higher. And look, all along the way, the market was dipping. It didn't dip a lot. Those dips were 1%, 2%, 3% most of the time. Excuse me. And so there wasn't anything out of the ordinary. But it was just a nice, steady upward trend over that whole time, because as money comes into the market, it doesn't just come all at once, right? This was 120 billion every month that was coming from the Fed. It was, checks being mailed to households, extended unemployment benefits, those type of things. So, you don't get this immediate impulse of money overnight. And so even in that environment, the most extreme environment that I can think of in recent history, the trend was a gradual trend higher. So yes, the market was melting up, but it was doing so in a fairly controlled manner.
All right, great. And sort of just as I gave a caution to maybe the folks who are on the very bearish side of things, I wanted to talk about this for the folks who are on the very bullish side of things, because I think in both cases, there's sentiment out there that I'm seeing a little bit more of, where people are saying, okay, this is the moment, and I got to push all my chips on this side of the table. And I'm not saying it can't happen.
Right.
I just wanted us to have a little dialogue here to say, what's the likelihood of it happening? And it is a quite low probability event. So if you want to position for it, great, but just be aware that, you probably want to have a lot of your portfolio positioned for it not happening, because that's a lot more probable, as best as we can tell at this stage.
Yeah, exactly. And look, like this is the way we're right now. We're pretty much fully allocated equities. We've been that way now for the past, past month or so. And, we're kind of positioning portfolios for this end of the year push higher, which again, we're looking at technicals, we're looking at trends, historical tendencies, those type of things. If that fails to mature, if for some reason, we get some surprise piece of economic data or whatever that suggests that the end of the year isn't going to be, maturing, then we'll reduce that equity exposure. But if October, November, December starts to play out as expected, then we'll probably overweight equity in our portfolio heading into year end. Now, again, predictions are only good for a month or two, and predictions are shoddy even, once you get past a month. I can pretty much guesstimate what's going to happen next week, and we write about that every day in our daily market commentary. Hey, here's what happened yesterday. This is what we expect to happen today. And we can pretty much nail that most of the time, because that's just what markets do. That's that kind of prediction, that 1 to 3 day prediction, 5 day prediction, kind of like weather predictions, is pretty easy to get right. Once you get, 2 weeks, 4 weeks out, it's getting a lot more, kind of hit and miss on that kind of prediction. So again, this is when we want to pay so much attention to the trend of the market, what's happening short term. Pay attention to sentiment. Sentiment's very bullish right now. So again, that's going to drive, the markets. Also, the most important thing about where markets go to between now and the end of the year and even into next year is pay attention to earnings estimates. Earnings estimates precede market moves. Why? Because if earnings estimates are going up, people are going, hey, earning estimates are going up. So that's lowering the valuation today that I can buy a stock for. And if the company's going to earn more money, the stock price is going to go up because of higher earnings. I need to buy in today. So there's a very good correlation between earnings estimates and forward returns on the stock market over the course of the next 3, 6, 9, 12 months. Now, once you get way out there, 2, 3 years, that's not the case. But over the short term, earnings estimates, and those are being ratcheted up right now because of expectations of stronger economic growth going into next year. That's also going to support the markets into the end of the year. Now, once economic predictions fail to pan out, those estimates will get cut, and then earnings will respond accordingly. So you got to be careful. It's all about timeframes.
Okay, great. And I was actually going to ask you about where the trajectory right now of earnings estimates sounds like they are beginning to get ratcheted back up. We're talking here right in mid-September, Lance, and one important element that drives stock prices, for better or worse, as we have discussed in the past, is stock buybacks. And we are entering the Q3 stock buyback blackout period, really as of right now. I think as of this weekend, roughly 50% of the S&P companies in the S&P index will be in that blackout period. It's going to last roughly 4 to 6 weeks, they say. Do you expect that to have any sort of near-term impact in the market action?
Yeah. It's an extraction of liquidity. So could see the market shop around a bit while they're kind of in blackout period. But again, as soon as we get back, two things are going to happen, right? You kind of have an offset in the short term. You get the extraction of the buybacks as you go into earnings season, but now we're going to have earnings season coming in, and earnings have been adjusted to a point to where, once again, we play the millennial earnings season game, which is where everybody gets a trophy for beating earnings estimates. So again, you'll get that support from earnings season, and then as soon as earnings season ends, then you get the support of buybacks coming back. And as I said earlier, that's going to be about $5 billion a week.
Okay, so maybe sort of a pause on the upward forces of the markets while we're in this blackout period, but obviously that money will come back in once the blackout period's over. And hey, if companies start beating earnings estimates, maybe even more than folks were expecting, that could add additional upward fuel and maybe be some of the triggers for that potential run to the end of the year we talked about earlier.
Right. And again, keeping in perspective, the market could be anywhere between, 4,500 and 4,650 by the end of the year, certainly possible. Anything outside of that, I would start really kind of discounting the possibilities of.
Okay. All right. So you mentioned that the Fed's meeting next week. We're going to hear from the Fed next week. You expect them to pretty much keep things as they are, and for the market to interpret that as, okay, yeah, the Fed's probably done here. May very well be true. But let me ask you this. Oil has made a big run in the past couple of months.
Yep.
It was in the 60s just in June. As of the day we're speaking here, Lance, it's now over $90 a barrel.
Yep.
Also, when we had cautioned folks about this to expect it because of base effects and just general stickiness, inflation is creeping back up right now, at least as measured by headline CPI, right? The August data came out at 3.7%. That's up from 3.0 in June and 3.2 in July. So, yes, the Fed did a good job of knocking it down from 9 to 3, but now it's creeping back up, right? Especially with oil going up like the way that it has. Could that be changing the game here a little bit? I mean, could that be really forcing the Fed to say, as much as I want to declare victory, I really can't with oil at these levels?
No. Oil doesn't impact the Fed's policy-making decision. Look, and there's a couple of reasons behind this. First of all, yeah, oil's got everybody's attention here short term, and that's fine and dandy. And oil ebbs and flows over time. So, oil prices are going to go up. They had a big sell-off in the summer. They got very oversold. So now you're getting a reflexive rally in the markets. And remember, what drives oil prices is commodities traders. So these are all just bets. Oil tends to cool off historically as we move into winter. If we get slower economic data coming out, that's going to pressure oil prices lower. If the dollar keeps strengthening, that's going to weigh on oil prices. So, we're probably close to the peak in oil prices near term. And so we'll see that cool off. But putting that aside for a moment, the Fed doesn't care about oil prices. So first of all, let's talk about CPI and how we calculate it. Yes, big impact right now on what's happening with inflation, and you should expect this, is the year-over-year comparisons. It's always a mathematical base effect. We had very big numbers of inflation back in 2022. So when we got to 2023, as you and I were talking about that inflation, 2021 and 2022, you and I were talking about in June and July, that we'd seen the peak in inflation because of the mathematical base effects. That number was going to come down very sharply. But as with all economic data, you should never expect data to trend in just solely one direction. It bounces along the way. We've had a very big decline. We're 9 to 3. You should expect a bounce. It's the mathematical year-over-year comparisons. And then you're going to have then inflation is going to start to tail off as we get into next year. Now, oil prices in particular have a very small impact on overall inflation. It's about 3% of the inflation measure. And energy as a whole is 7% of inflation. That includes heating oil, oil for your car, gasoline, electricity costs, utility costs, those type of things. All the factors of energy that goes into the household equation is about 7% of the index. Almost 40% of the index is housing and housing related components. In other words, the homeowner's equivalent rent. That runs about a 3 to 6 month lag. Home prices are declining. There's still a huge impact of lower home prices coming in to the inflation calculation, which far outweigh any impact ultimately coming from energy prices. But most importantly, because energy prices and food prices are so volatile, and they go up and they go down from one month to the next, the Federal Reserve excludes those from policymaking. If the Fed looked at oil prices as a function, and let's say they looked at headline CPI, they'd be changing monetary policy every month, and they can't do that. So they strip out these more volatile sectors and look at the core inflation, which that came in at 0.3. So multiply that by 12. That's basically 3.6% inflation. On a long-term basis, we're going to average that around 0.2% ultimately. So you're looking at 2.4% inflation on average. Yeah, you're going to get a little bump every now and then, but you're going to start to average inflation back down towards 2% on the core reads. And that's going to remain suppressed primarily because of what's happening with housing and rental rates and what's going on the big factors that actually influence core CPI.
Okay. So you're basically saying you're not that worried about the policy implications of the rise in oil prices that we've seen over the past couple of months. Oil being relatively volatile, you expect that we're probably, you said, getting near a peak in prices, probably come back down again. It's kind of a non-issue for the Fed right now because it's not even included in the core CPI that they're navigating their policy by. So now I presume there's some level at which if oil got to or stayed above for a prolonged period of time, you might change your tune, but you don't see anything yet to make you worry about that.
No, that's not what I said. I said the Fed doesn't, when you're talking about policy making, the Fed doesn't include those points in the inflation metric, right? And they'll always strip that out because of volatility. But don't be surprised if the Fed comes out and says, hey, we are watching energy prices. We are watching what's going on because that's an impact to the economy. But those aren't positive impacts, right? So just think about historically what happens let's just say that some of the people out there predicting $100, $120 a barrel oil occurs again.
That's where I was going to go, Leo. So oil goes to 120 and stays there for all of next year.
Yeah, for a whole year, right? So what would happen to the economy at that point? And what would happen with economic growth at that point? And see, these are the things that we often forget, and that these have severe impacts to the overall economy. The subject of our newsletter last weekend was oil price inflation, interest rates, and what's the link. And that was that chart of seasonality right there. But we go back and look at the market over time. So again, talking about inflation, what's the calculation of inflation? This is CPI broken down over the course of the last 5 months and the weights of each sector. And you can see housing makes up, housing and everything related to housing is a very, very big chunk of the actual housing calculation. Energy isn't even weighted because it's included in transportation and housing. And again, that makes up about 7% of that total calculation. So again, energy as a function doesn't have a whole lot of impact on the overall inflation number. But here's oil prices versus core inflation going back to the 1960s. And let me pause that. So now what you'll notice is, and we've talked about this before, is that when you have big spikes in oil prices, they don't tend to stay around for exceedingly long periods of time. So generally, when you have a big spike in oil, you're going to have some type of economic event that occurs, and then oil prices are going to correct. And that's kind of just the history of oil prices as a function. Core inflation doesn't really have a big correlation with oil prices over time. It has recently, there's been a pickup in the correlation recently because of all that money that we flooded into the system, stimulus payments and everything else. We shut down the economy. We gave everybody, money to spend. So they all went out and spent it. So that created a big surge in demand for all types of commodities. So the recent correlation of oil prices has certainly been, let me back up one here. This recent correlation in oil prices inflation is certainly evident, but that's not the history of oil prices and inflation, particularly going back to the turn of the century. There's not a huge correlation. And we can actually see that. This was a chart by Michael Leibowitz last week in our daily market commentary. This is crude versus 5 years and 5-year inflation expectations. And that's a fairly high correlation. But once you spit this out and look at crude versus inflation, that correlation drops to about 32%. And what that says is that people expect, oil energy prices are up, so I expect there to be a big correlation with inflation, but the reality is drastically different. And there's a very low correlation between, as I just showed you, there's a very low correlation between energy prices and inflation over time.
All right, interesting. Boy, I'm just curious.
There's a whole lot more to this article, by the way. I just stopped there.
Oil prices go up. I think people say, oil's in everything. Therefore, it's going to be inflationary. You're saying the data doesn't necessarily show that very often. I'm just curious, does it act with a delay? I mean, oil is in everything. And so if the price of oil goes up now, maybe there is a higher correlation, but maybe we don't see it until 9 months down the road or 12 months down the road. I don't know. I'm just asking, do you see that in the data at all?
No, not really. Again, and this is a better chart of oil prices over time. But, you can see that every time there's a spike in energy prices, it creates some type of problem economically, either recession or some type of event.
It's almost like too high interest rates, right?
It is. Well, but there's also one other component of this is if oil prices go up, I'm an energy company, right? I'm ExxonMobil. If oil prices go up, what am I going to do?
Well,
I'm going to produce more oil, right? I'm going to take advantage of that. And that's why, back in 2008, everybody was worried about peak oil price. And this is always important to remember. Energy companies do not set the price of oil. You and me buying stuff at the gas station does not set the price of oil. Oil is set by NYMEX. It's set by energy traders that are buying and selling options, right? So back in 2008, everybody was like, oh my God, we're running out of oil. And we were running up the price of oil like crazy. And then we discovered, fracking. And this was the response by energy companies going, man, at $130 a barrel, I can do stuff that previously was not economically feasible. At $80 a barrel or at $50 a barrel or at $30, when we're down at $30 a barrel, I can't drill offshore. It's too expensive to drill offshore at $30 a barrel. But at $80 a barrel, I can start drilling offshore again. At $100 a barrel, you bet your ass I'm building a new drill out in the middle of the Gulf somewhere. I don't care what's going on because I can extract that oil at an economically beneficial cost. So as soon as prices go up, energy companies are going to respond by drilling more oil. And that's what's ultimately going to happen is that if energy prices do go, and look, and energy prices are just, again, take a look at where we were last year, the Russia-Ukraine war. Energy prices had a big decline. You're getting a bounce in energy prices, exactly what you should expect them to do. They just got really oversold. They're bouncing here a bit. And then you'll have your economic slowdown next year. And when you have a recession, energy prices decline. So, that's just the function of the way the world's going to work.
Okay. I also just want to remind folks too that Lance, you are based in Houston. So more than the average financial advisor, you are kind of closer to the pulse of the oil industry, given your location and the folks that you interact with.
Right. Yeah, exactly.
All right. Look, I want to switch gears here a little bit. Earlier this week, I interviewed Michael Pinto, who, Lance, I think you guys see the world very similarly in most cases. One point of difference, and it's really just a difference of timing, It's not a difference of expectation or philosophy. I think it's just a difference of when certain events might happen. Now, Michael highlighted that I think a lot of viewers have been talking about has been his outlook for US Treasuries, where right now he is pretty much sitting in the very short end of the curve and saying, I don't think it's time yet to go out on the long duration side of US Treasuries. There will be a time when he's waiting to do that. He has a model he's created that he's waiting to tell him that it's that time. Now, obviously, you and your partner there, Michael Leibowitz, have relatively recently said, you know what, I think now is the time to start extending. And you talked about how you have swapped the TLT part of your portfolio for actual long bonds themselves. And commensurate with that, have you been increasing the part of the portfolio that you've been shifting from short to long?
Not yet. So we still have half of our bond portfolio fairly short in duration, but we did extend the longer end part of our. So we run a bond barbell, right? So we've got different maturity ranges across the board in terms of bonds, and right now there's no reason to shift out of that really short end because we're getting paid well on it at 4% yields or whatever.
It's sorry to interrupt, but you said you're about half and half right now, short long?
About half and half.
Okay,
yeah.
And I just want to emphasize that because I believe that is different from Michael. I think Michael is 100% short right now.
Yeah.
So anyways.
Yeah. So and actually we're not even half and half. So we have 40% of our portfolio in bonds. And okay, let me back up real quick. So our portfolio is a 60-40 allocation. So we have 60% equities, 40% bonds. Out of our 40% bond portfolio, we have 13% in long duration. Right. Everything else is medium to short or cash. Right. So we still hold a pretty big cash holding, even on the bond side of the portfolio. And then our equity portion is 60%. So again, as we start to see interest rate, and look, interest rates have probably peaked where we are. We're probably not going to see substantially higher interest rates here. Sure, we could get to 4.5%, but bad things are going to start happening once you get above 4.5%. Bad things will start happening economically. So we're probably either at or near the peak in interest rates. So we went ahead and made that shift last week by switching from into an actual 20-year Treasury bond, locking in that rate because at 4.5%, that's a big help to the portfolio return over time. I can throw 4.5% in the portfolio. That's easy. So that part we did. And, but there's been a lot of talk lately about the return of the bond vigilantes and how, with inflation where it is and what the Fed's doing and where things are going, that, nobody's going to want to buy the Treasuries unless they get paid much higher rate. And there's just not a lot of support for that case.
All right. If we're going to say why, Lance. So.
Well, why isn't it, Lance? Well, let me ask you a couple. First of all, today's article on our website is actually discussing this, but let me just ask you a couple of questions here real quick. We have 32 trillion in debt, right? So and that's just in government debt. That doesn't count, the 150% of leverage that we have in households and corporations that are all based upon ultra low interest rates. So what happens if the world says, okay, I'm demanding a higher rate. If I'm going to loan you money, if I'm going to loan corporations money, if I'm going to loan households money, I'm going to demand a much higher rate. What happens economically?
Yeah, well, this is what you and I've been talking about forever with the lag effect, right? Just less can get done.
That's right. And so eventually, if less gets done, economic growth slows. And if economic growth slows, since interest rates are a function of inflation expectations, economic growth expectations, opportunity costs, then interest rates are going to come down to reflect that reality of what's happening economically and with inflation. So as the negative impact of higher rates weighs on the overall market, then interest rates will start to reflect that. We'll just go through it. So some quick analysis here. And this is just really, again, and if you want to take your time and read the article and look at the charts in more detail, it's on the website, goinvestmentadvice.com. It's just called Bond Vigilantes and the Waiting for Godot, because so first of all, the term bond vigilantes was termed by Ed Yardeni back in 1980.
Did Yardeni coin it? I didn't know that.
Yeah, back in 1980. And we've been waiting on the bond vigilantes to return since 1980, and they haven't. And what's interesting is that we now have, so what this chart shows you that you're looking at right now, is the 10-year interest rates versus the change in rates on an annual basis versus, economic events over time. And every time that you have big changes in rates, you have either a recession or some type of financial event or crisis that then in turn makes interest rates go lower. This is by far the largest change in rates we've ever had in history, period. So if you don't think this is going to ultimately revolve into, and especially if you think rates are going to keep going up, if you don't think we're not going to have a financial event or recession, there's no evidence to support that going back at least to 1954. But let's go back even further. How about 1787? Not my chart. This is Bank of America. But since 1787, the bond market has never had a negative return 3 years in a row. If it does it this year, this will be the first time since 1787. The point, though, being even in the 70s, where everybody was, this is what everybody refers back to, is like the 70s were terrible for interest rates. The bond market cranked out positive returns almost every year, even during the 70s. And so if you're going to bet on an ongoing negative return in bonds after this year, that's a very, very tough bet to hold on to, because again, history going back to 1787 doesn't support bonds having negative returns more than 2 years in a row, much less 3 years in a row, much less 4 years in a row. So again, just history is really starting to weigh on your side.
Go back.
I'm sorry, go back.
Yeah.
Yes.
Finish your point.
I'm finished. I was moving.
Okay. All right. So, basically you were saying, look, 2 years of declines in treasury bonds is rare. 3 years of declines never happened before in this data series, might happen this year, right? You're saying betting on a fourth, highly, highly, highly unlikely, right? You'll never say never, as you said earlier, but it's as close to a sure bet as one could probably get, right? So let me just ask you though. So we're having this unprecedented third down year so far. Maybe the year ends with higher bond prices and lower rates, but maybe not, right? So what is causing this? Is this basically just a reflection, as you said earlier, that this is the most aggressive rate hike period we've ever had?
Yeah, again, interest rates where they are currently are reflecting three things. They're reflecting wage growth, they're reflecting inflation, and they're economic growth. What's it to come in right now from the Atlanta Fed? Have you looked at the latest read? It was 5.2 or 5.3 the other day.
It's 4.9 as of the day we're talking about.
Okay, so 4.9. So you got 4.9% economic growth. So just that math, right? If you have 4.9% economic growth, what should the interest rate be?
Well, it should be somewhere
around 4.9, right? So we're 4.3-ish. That's about where it should be. That's so where's inflation? Inflation's 3.7 on the latest read, and you're at 4.3 on GDP on interest rates, and 4.9 on GDP. So interest rates are just reflecting where you are in terms of economic growth and inflation. Also, it reflects where the Fed is. The Fed's currently at 5%. So the 10-year rate is really just reflecting all these economic and financial variables. And unfortunately, whenever the Fed has had rates this high previously, outcomes have not been great for either the stock market or for the economy. And so this is, but again, and when we go back and talk about bond vigilantes for a second, let's remember one thing, is that the statement, to Ed Yardeni's point about the bond vigilantes are now saddling back up, this is all based upon the premise that all else is equal. And I want you to take that home and think about it. If all else is equal, then Ed Yardeni is probably right about the bond vigilantes saddling back up, or Jeff Gundlach, or whoever else is saying this. And what their arguments are is that in the current environment, that bond buyers are going to demand a higher rate for treasury bonds to compensate for higher rates of inflation and higher rates of economic growth and higher wages, right? So there's a very close correlation to that. And they're absolutely right about that story. So if all else is equal, if I'm the guy out here buying bonds, and the government comes to me and says, Lance, I'm going to offer you a 10-year treasury at 2%. I'm like, why? Inflation is 4. So if inflation is 4, why would I take 2 on a 10-year treasury when I've got to accommodate for 4% inflation? I'm losing money. So as a bond buyer, I'm going to say, hey, you got to step up the rate in order for me to buy it. So all else equal, that's the way the market should work. But we're not in an all else is equal environment anymore, because as soon as interest rates get to the point that it starts damaging the economy or starts creating financial scenarios, central banks globally have been stepping in to be the sole bond buyer of bonds. So we're not in an all else is equal environment. We're in an environment where, in the event the market doesn't show up to buy bonds and keep rates suppressed, because again, going back to our previous statement, which is the economy can't withstand higher rates because of all the leverage, 32 trillion in government debt, not to mention corporates and households. So as soon as you start to break either the financial market or the economy, which will happen, the central banks are going to step in. Don't believe me? Let's just go back to March for a second. Adam, what happened in March, in particular of this year?
We had a lot of instability in the banking system.
Right. And what did the Fed do?
It stepped in and created a new funding facility, the BFTP.
Exactly. And so can you imagine if and why did we have this problem? Was because interest rates went up. It suppressed the collateral values of the banks. We had banks fail because these weren't bad banks. These weren't banks that were doing subprime mortgages or bad loans. They were holding treasuries. It's just a function of because we do fractional reserve banking, the value of their good quality collateral fell because the Fed was hiking interest rates, created a collateral problem for the banks, and they had to get bailed out. And so the Federal Reserve stepped in. Can you imagine what would happen to not just regional banks, but to JP Morgan, to Bank of America, to Wells Fargo, to our systemically important banks, if interest rates were at 5 or 6 or 7% in terms of their collateral? We would be right back in the midst of a 2008 financial crisis, and the federal government would be stepping in to buy bonds to suppress rates in order to get that situation resolved very quickly. So all else is not equal. And when we talk about the level of debt in particular, we're at 32 trillion, approaching 33 trillion right now. The CBO just projected and just did their projections through 2050 on the amount of debt to GDP. So if we work that number, we're talking about roughly 140 trillion in debt by 2050. The Federal Reserve will have to monetize roughly 30% of that debt. So you're talking about the Federal Reserve's balance sheet between now and 2050 going from $8 trillion to roughly $40 trillion in order to monetize enough debt to keep interest rates at levels that are systemically functional. And so when you start talking about bond vigilantism, it sounds great in theory. It's just we don't have a normally operating, functioning, bond market, much less do we have a normal functioning stock market. But we certainly don't have it in the bond market and aren't going to have it because central banks are standing ready. Not just the Fed, it's the ECB, it's the BOJ, it's the Bank of China, all stepping in to buy bonds as needed.
And nobody's done this more than the BOJ. So you're basically
wait.
Okay.
Take away my punchline.
Okay, sorry. Go ahead.
So yeah, but no, you stole my thunder, because again, if you want to take a look at a microcosm of where we're headed, since 1995, Japan's debt to GDP ratio has gone from basically 65% to over 220% of debt to GDP. In the US, we're about 120-ish right now. And look at what's happened with economic growth and interest rates over that time. Economic growth has slowed. Interest rates have slowed. Interest rates are near zero. And they've been that way for a long time. The bond vigilantes never showed up in Japan. And if bond vigilantes were going to show up anywhere, it should have been in Japan. And the reason that they didn't show up is because the Bank of Japan now owns roughly 80% of the bond market, the stock market, and the ETF market. And so that's how they keep rates suppressed and try to create some rate of economic growth. But as you can see, Japan's plagued by recessions about every 3 to 4 years. And it's just they have these little spurts of growth, and then the impact of debt and economic realities show up, and you have another recession again. But importantly, going back over time, interest rates are relative around the world. You can't have one country with one set of rates and another country with another set of rates. And Japan and the US have a lot of similarities: aging demographics, large import-export economy, high debt to GDP ratios, high dependency on welfare programs, low savings rates, structural shifts in employment. So the outcome ultimately for interest rates is not one of a higher interest rate environment. It's one of a much lower interest rate environment, and one where central banks are going to be maintaining those low interest rates to keep the economy on life support. Now I'm done. Go.
Okay. Yeah. No. So great analysis, and lots of questions. But let me get to the main one here and keep that chart up for 1 second.
Oh, sorry.
I knew you were going to go get rid of it while I was talking.
I was too fast.
So big picture question: is the U.S. Japanifying?
Yes.
Yes, and it's interesting because we can look at there's a delta between the U.S. data there and the Japanese data share there. U.S. data is higher, but the trajectory in both cases is down. And if you look at where we are, let's say where we were in the mid 20-teens, that's where Japan was in the 90s, right?
Right.
And so we're just heading on that trajectory. So you believe that because of the debt situation, more and more the Fed is going to have to intervene, and it will eventually be buying more and more and more of the debt issuance of our nation, the same way it's happened in Japan.
Yeah, well, and the same way it's happening in Europe, the same way it's happening, everywhere else. And yeah, that's not going to change because, again, what central banks can't afford to do. And again, you and I have talked about this before. What is it that politics, and let's remember, central banks are a function of who? The politicians. What is it that the politicians don't want to do? And again, we're about to come up on this whole, we're about to have a government shutdown here in October. So we're about to have the Republicans come out, all beat their chest, how they're going to hold everybody hostage to get cuts in spending and to separate Ukraine spending out from, other spending. And they're going to have a lot of chest beating. And at the last minute, they'll all cave and pass a continuing resolution to continue spending with an 8% increase. Because at the end of the day, what no politician wants is a poor, weak economy, because they won't get elected, and they know this. Right. So,
they will not pursue austerity willingly. It's
exactly. And so until, and again, you say, well, that's just going to happen anytime now. One important part about this chart between Japan and the U.S. is, remember that Japan is running a 30-year head start on the U.S. So where our interest rates are now, or where the Japan's interest rates were previously, and they're 30 years ahead of us on where rates will ultimately wind up. And again, we're talking about a period where interest rates are going to be stuck near zero because you can't afford higher rates. Because when rates go up, you start impacting debt across the board. And again, this goes back to basic economic growth. Where does economic growth come from? It comes from wages. If wages aren't growing fast enough to keep up with the economy, which they're not, then people have to delve into credit card debt to sustain their standard of living. This is why it takes roughly about $8,000 a year in additional credit card debt just to supplement the incomes of individuals to maintain their living standard. So again, interest rates go up. I can't take on more credit card debt. The economy slows down. I have a recession. If interest rates go up, you impair the banks. There is no good outcome for higher rates where the Federal Reserve is not required to step in, and central banks and the governments to step in to suppress interest rates back to low levels. So, the bond vigilantes are going to get, basically wrangled by the sheriffs eventually.
Well, okay. And that's where I was going to go, because you titled your article there, Bond Vigilantes and the Town Sheriff, right? With the central bank being the town sheriff here. And let me just recap, because I want to make an important point here. In the 80s, the bond vigilantes had a lot more power to push the bond market around, right?
Yep.
Now, because the system is so heavily indebted, the economy at large can't support interest rates above a certain threshold. And that's something the central bank knows well. And so it has to intervene in order to keep the economy limping along, chugging along, whatever analogy you want to use. It's got to come in and get interest rates down when they get above a certain level. Right now, it has raised them to relatively high levels recently. And it's doing that almost like the way that you use chemotherapy in a patient, right? You're putting a poison in the body, but your hope is you're going to kill the cancer first, and then you can bring the patient back to health. That's what the Federal Reserve's trying to do right now. But to your point, you're saying it's going to have to bring those things down. That's what you're counting on, is the town sheriff coming in to do that. So that's what's different this time, right? That's what's different from the early 80s. Now, you said, look, we're seeing this happen worldwide. Japan is giving us, a decades ahead view of where we're going to end up, right? So, we had the chapter where the market ran more freely. We now have the era of big central bank intervention. But that has an end date too, Lance, right? You can only get to the point where the central bank, owns everything, right? Where you don't really have functioning markets anymore, and you're basically just printing fresh currency to meet all these nominal debt payments. And basically you've killed your currency, and your economy goes moribund. So there will be a post-central bank intervention era, right? We have no idea when that's going to arrive. But I just want to say, this playbook that's being run cannot be run forever, correct?
Well, yes, that would make completely logical sense. And 30 years later, Japan's still doing it. Back in 2020, we were writing articles talking about Japan being, a fly in search of a windshield, and just at any point, Japan was going to implode, couldn't sustain their debt to GDP, long term. 23 years later, that fly is still searching for that windshield. So, how long can it take? Is it 30 years? Is it 50 years?
We may not be alive when this era ends, but
I feel sorry for whoever is. It's going to be terrible for the Gen Zers, I guess, or maybe whoever. What comes after Z? The Gen 1s.
No, Alpha. If you can believe it, they're going to A.
Okay, so Gen Alpha, maybe it's their problem, but it's not going to be. The era of financial capitalism is coming to a drastic end, and it's unfortunate because it's what made America the wealthiest economy in the world, and the history of the world by far. We're destroying that as fast as we can, but and I feel sorry for those that are coming down the road because they just won't have the opportunities because of the debt.
It's very sad. I'm going to try to find this comic, but there's a New Yorker comic out there that shows this man in like a tattered suit, right? It's rags at this point. And he's sitting around a campfire with these young children. And he says, yes, we destroyed the world, but for a brief moment, boy, did we create a lot of shareholder value.
Yeah. It's unfortunate, but yes, that's the case.
It's super sad. All right. Well, look, real quickly, you mentioned the potential of a government shutdown coming. Yeah. I just want to note there's an article that recently came out about I think it was by Goldman, saying, hey, there are sort of three things that it's got them looking at to say these are likely going to be drags on GDP in Q4. Yep. And let me just list them because we'll probably come back to talk about them in future videos. One we've already talked a lot about. It's the resumption of student loan payments. They're projecting that's going to subtract at least 0.5% and likely much more, they say, from quarterly annualized GDP growth in Q4. So, we've been talking about keeping an eye on that impact. Secondly, they said that government looks more than likely to shut down for some temporary period of time as all those histrionics go on that you talk about, Lance. They say that's going to impact growth by about 0.2%. And then they say, and I haven't been keeping enough of a close eye on this, I guess, that reduced auto production from a potential United Auto Workers strike could reduce annualized growth by 0.1% of GDP for each week it lasts here. Right. So we got to keep our eye on these three things because these could be things that weigh more heavily on growth than we currently have right now.
Well, and I'd also expect that just from the function of the lag effect of interest rates and inflationary pressures, et cetera, that, the bump we've seen in GDP growth in the first half of this year because of the Inflation Reduction Act, we're probably getting towards the tail end of that. So, seeing some weaker economic data in Q4, and if not in Q4, Q1, Q2 of next year, won't be surprising at all because, again, there's not another big spending package coming behind the Inflation Reduction Act, which didn't really reduce inflation, but actually sustained it a bit. But that's going to fade out as we get into early part of next year. So I think we're going to start to see weaker economic data coming in as we get further into the year. The one thing to really watch, and to your point about student loan payments, is watch holiday spending, because that's where I think you're going to see that really showing up, is as that student loan payment resumes, how much does that really impact retail spending, which is 40%-ish of the PCE number, which is roughly 70%-ish of the GDP calculation. So it could be more than 0.5% impact, as Goldman notes.
Okay. Well, folks, we'll keep a close eye on this, and we'll be reporting on this week after week going forward. So we'll let you know how the numbers are floating out there. A couple quick things I just wanted to note. One is money market inflows continue to hit new highs. And banks are continuing to tap the BFTP program, right? That rescue program for banks. I think we're still seeing here that the banking crisis is not resolved here, right? This BTFP is supposed to be, some bit of a scarlet letter, for a bank to tap, but it's not keeping them from doing that. And more and more, it looks like, capital is still fleeing the banks, understandably, right? While there's still such a big arbitrage between the lesser amount your bank is willing to pay you on your savings versus what you can get simply by making a mouse click or two in a money market fund or just buying T-bills directly.
Right. That's right. And the reason that's the case is rates haven't come down yet. So, that problem is not going to alleviate until we start to see either the Fed cutting rates or interest rates come down on their own, which would be in relation to an economic slowdown.
Okay. And I now want to get to your trades, Lance, that you made for the week, but real quick, I do want to mention one bit of data. This one is actually maybe on the positive, surprisingly positive side, but FreightWaves, which was it's a trucking industry association that tracks all the data from the shipping and trucking industry, has said that increasing number of truckload carriers are saying that they think the bottom of the cycle has likely occurred. They're saying you're probably not going to see a lot of improvement until at least sometime, substantially into 2024. But that kind of the hemorrhaging of that sector seems to be ending here. So if true, that's, we've been talking a lot about how a lot of these shipping and distribution companies, they're the circulatory system of the economy of real things getting from point A to point B. And the numbers there have been pretty dismal for the past year and a half. To hear that things may actually be stabilizing there, well, that's maybe an early indicator that, there is maybe some more recovery in the story than we've been estimating so far. But I don't know. We'll keep an eye on it. This is the first time I've heard something positive, out of this industry in a good while.
Well, and again, you also remember that we had such an abnormal increase in that activity because $5 trillion in stimulus, we shut down the economy, everybody's sitting at home ordering stuff online, going to Home Depot and Lowe's to buy, that.
They couldn't unload the ships fast enough. Yeah,
exactly. So we had this, I was reading articles, back then where they were willing to pay truckers $600,000 to, truck because they couldn't find anybody to do that. So really what's happening, you always have to keep economic data kind of in check, is that a lot of the stuff that happened in 2021 and 2022 is just returning to normal. If you take a look at the stock market, going back to 2009 is a good example. We had such a massive increase in the stock market because of all that stimulus that while 2022, that correction was like, oh, it's a bear market and the world's coming to an end. All we did was return back to the bullish trend line that we had from 2009. We just worked off all that monetary excess. And so a lot of this that we're seeing is just a return to normalcy, but because it was so good there, now it looks terrible, right? So, it just may mean that we're getting back to normal and we don't see that type of we're getting back to that 2% growth trend in the economy, maybe a little bit less, and that'll be the new normal.
All right. Well, I think that, we've talked in the past too about kind of the bullwhip effect, right? And that's pretty much what the pandemic was on steroids, right? I mean, it wang things around to remarkable extremes. And to a certain
hopefully we learned our lessons about the stupidity of MMT. So now that we've gotten that out of our system, hopefully we won't do that again.
Hopefully, and I said we get your trades, but now that you mentioned that, I'll mention this really quickly. If folks haven't yet, and if you're interested in the real estate market, really recommend that you watch the video that we released earlier this week with housing analyst Melody Wright. She has worked in the mortgage lending industry her whole life. She very much remembers the damage caused during the 2007 housing bubble bursting. She very much remembers just the completely ill-advised decisions that were made back then to sort of extend and pretend, and thought we'd never ever do that again. That the industry clearly learned its lesson, and she's been increasingly discomfited by kind of hearing and seeing very similar echoes now of bad decisions, bad practices, magical thinking, extend and pretend, all that type of stuff that she saw back then. She's beginning to see that a lot now in the housing market. She talks a lot about it in the interview that I did with her. But one of the things that's so interesting about her current analysis is, she does a lot of data crunching. I mean, that's what she does for a living, but she also has just, gotten in the car and driven to a number of the, recently most active real estate markets across America, the Austins, the Phoenixes, the Las Vegases, the Nashvilles, the Miamis, and just like literally driven around and done a lot of boots on the ground investigation. And she's found that there is certainly the industry itself is suffering from a lot of bad data or just incomplete data. And one of the things that she's finding by driving around is that there's an awful lot of speculative, spec building inventory that is been built, but it's being held from being on the market. And so it's not appearing in MLS listings, obviously. And then she's finding other areas where there's a lot of properties that are being available for sale, oftentimes in these kind of like multi-dwelling communities that are being kept from MLS. So basically her story is, what you see on the ground is not matching the data that the industry itself is using. And she's ringing a bell similar to the one that Amy Nixon is ringing kind of with the Airbnb market, is there is a lot of inventory that looks increasingly likely that it's going to be kind of flooding onto the market at some point over the next couple of years. And so everybody who is sort of living and breathing by the we have this housing inventory shortage, housing prices can't possibly come down because we don't have enough units. I would, if you believe that at all, you definitely should watch that video with Melody.
Yeah. So I wrote an article probably about a year and a half or so ago, talking about how there never is an inventory shortage. And that's a myth of the market because it's all a function of price. And
not unlike in many ways the oil industry.
Exactly. And so when prices hit a point to where, and this works in two ways, right? So if home prices are going up, that's going to drag more inventory to the market, because I may be sitting on my house going, I'm not really, well, I'll tell you, I did it right back in July of last year. Prices were going up and I'm like, I'll never see this value on my house. I love my house. I didn't want to sell it. I mean, we built it. It was our custom home. We built it from scratch, me and my wife. We loved everything about it. It was a beautiful house. But the prices were so ridiculous. We go, we can't afford not to sell this. And so we sold it. And the same thing comes down too. And when prices are coming down, there's a point to where people that are sitting on equity in their home, and they have equity in their home, when they start to see that and remember, for most people, when you look at net worth, a big chunk of their net worth is the equity in their home. And when that equity in their home starts to erode, they'll sell it and they'll do something else. And so it works in both manners, but there's never an inventory shortage. At a certain price point, inventory will flood the market. And that's either has to do with interest rates or price or whatever it is, but you'll get a big uptick in interest rates. And it's interesting right now because, I talk to a lot of young people, and they're like, well, it's just not fair what homes cost these days. And I go, hey, I get it. But, it's the very people trying to sell you the house that's creating the problem. And there's no better example of that this week. Now, Fannie Mae recently came out with a 3% down mortgage. Stop doing that. If you want home prices to normalize, quit letting people into a house for 3% down. Make them have some skin in the game, 20% down. Home prices will come back down to where they're supposed to be. But now Zillow and Rocket Mortgage are eating 2% of that down payment. So now you can get to a house with 1%. Last time we saw that stuff, so you don't bleep me out again, well, it was back in 2006, 2007. So yeah, if you want home prices to come down and get affordable, stop doing stuff that distorts the price of mortgages, right? And start and look, you didn't have housing price bubbles back in the 80s and the 90s because you had to put 20% down. You couldn't split your mortgage between two mortgages to avoid PMI. We didn't have all these adjustable rate funky mortgages. Just get back to you put 20% down on a house, housing prices will align with inflation, and you'll be able to afford to own a home.
Oh, well, hallelujah, brother. I mean, I'm right there behind you on that. It's funny when Zillow, I think I was trying to remember who I was interviewing the day that Zillow announcement came out. It might've been Stephanie Pomboy. And I said to her, all right, I'm calling it right now. T minus 12 months when we start seeing the headlines that say Zillow exits disastrous 1%, mortgage.
Absolutely. Because they're going to
said the smart money was taking the under on that. Yeah,
absolutely.
Yeah. Real quick, just because you mentioned it, you caught yourself and you said stuff. I have bleeped out some of your more colorful language recently, and I've had a couple of people in the comments say, "Come on, we're all adults here. What are you doing?" And just to be super clear, it's not the language. I would love to let you be yourself, Lance, as much as possible. The reason why we're bleeping it out, folks, just so you understand the business behind all this, is I don't care about it. We're all adults here. YouTube cares about it. And so, in terms of getting these videos watched and shared, if there's stuff in there that the algo doesn't like, it will basically penalize the videos. In certain cases, it can give you strikes or even deplatform you. That's why we're doing it.
All I got to say is that in Texas, bull poop is a real word.
Yeah, I'm sure it is. I'm sure
that is not profanity. That is just the reality of where we live. So when I call something what it is, that's what it is. Anyway, you'll never hear me drop the F-bomb, but you'll hear me say the S word a lot. So yeah.
Well, anyways, folks, just letting you know, I'm not trying to, it's not my morality being layered on Lance. It's really more the algos. All right. Well, Lance, trades.
Yes.
So what, if any, have you made over the past week?
We're really just kind of working on rebalancing the portfolio. Again, we're expecting this kind of October, November, December rally. Wherever it starts, it'll start. It could be November, it could be October, it could be early December. So we're just basically realigning our portfolio, trying to benchmark, get closer to our benchmark weighting. And so this week we sold Coke. We had bought Coca-Cola Enterprises, Coca-Cola Company previously. We were looking at, we talked about earlier, I think in June or July, about sector and staples were really old. And so we did the fundamental work, and we settled on buying Coke in the portfolio for basically kind of a rotation to the staples. It didn't work. And so we sold that, and we rotated those shares into Apple and to Procter & Gamble, which we also own. So what we're trying to do is decrease the number of holdings in our portfolio and increase the weights. So our goal, we were at 26 holdings. Our goal is to get down to 20. And so over the course of the next couple of months, we're going to be making some more consolidated movements in the portfolio.
Okay, great. All right. Well, look, in wrapping up here, folks, I just wanted to end by opining on something that you and I talked about, Lance, after we finished recording last week, which is, and if you're a fan of Wealthion, hopefully I'd love to get your folks' opinion on this. But I've had several people on this channel, several of the guests that I've interviewed, make similar comments, which I just wanted to share with folks because I thought it was so interesting. So I've been in digital media most of my career here. And I've seen, the evolution from the start of the internet to more and more, media getting digitized and coming online, new formats happening online. And I would say sort of the general migration of audiences from traditional media sources into digital ones, for better or worse. There's lots of pros, lots of cons. But in the case of financial media, a big reason why I started Wealthion was because I didn't feel that people were being terribly well served in the standard mass financial media. And if you're watching this video, you're probably resonating with at least a good deal of you, is you're not getting what I like to call kind of financially nutritious enough information through a lot of the soundbite or advertorial, that gets pushed on, a lot of the viewers of traditional financial media. And so you're coming online trying to self-educate and find information that's at least goes deeper, gives you more than just a soundbite, lets you really explore, all sides of an issue. But in many ways, I think maybe, a lot more agnostic, a lot more unbiased, whatever. That's my bias for having started this channel. And obviously it's collected a number of people who, I guess it's working for, which is great. So that's on the audience side. But what's interesting is on the expert side, I've talked to some experts recently who have basically told me that they are pretty much done going on a lot of these traditional financial media sources, especially TV, like cable or network, financial TV. They've said, look, I've done it for a number of years. I've noticed I get less and less bump to my business from it. I don't get to explain myself fully. It's kind of like a lot of hassle and I get very little return for it. And I'm really just only now focusing on the platforms that, really let me get my ideas fully out there where I can fully express my thinking and my analysis, and that drive my business. And I just found it so interesting that, in the course of, 7 days, I've had unprompted several experts basically say, hey, thanks for letting me come on Wealthion. In fact, I'd like to do more with you because platforms like yours are really where, I see the true value. And so it's kind of interesting. I'm just sharing this as a student of media is, we're seeing this kind of interesting overlap now where more of the audience and more of the experts are coming more onto platforms like this because it works more for them. Now, honestly, I'm not an unbiased party, in this hunt here because I have this channel. But folks, if you're watching and you have any feedback on that, positive, negative, or just personal anecdotes to share, please let me know in the comment section. I'd really like to know. And Lance, I don't want to speak for you, but when we were chatting, I got the impression that you've more or less come to similar conclusions yourself as an expert out there.
Yeah, no, I used to do a tremendous amount of media. I only do the only media I do now is I have a kind of a regular spot that I do on Fox Business with Charles Payne. But outside of that, I have my own podcast that we run every day, and just a couple of others that people I really respect that I'll do stuff with. But outside of that, I've pretty much cut out doing most of the media. And even while I enjoy doing Fox Business and it's a nice thing, that it does nothing really. I don't get any traction to my website. I don't get any traction to my blogs, any of that from national media. So again, I agree with some of the other commenters that have said that, is that there's not a whole lot of benefit to doing that. I'll go speak at conferences. I'll go where I can, have a full discussion, promote, our blogs, promote our newsletter, which are all free, by the way. We don't charge for that stuff. But that's what ultimately gives, our business the ability to grow, which is what keeps me coming back here to do this. So there you go.
Cool.
Yeah, I absolutely agree with that.
All right. Well, look, interesting because you mentioned Charles Payne, who's a really good guy. Just to sort of folks give you a little window into kind of the arc of my journey in digital media. So right out of getting my MBA from Stanford, I was in my late 20s. I ended up at Yahoo Finance. I was running marketing for Yahoo Finance. And back then, Yahoo Finance was starting, I think, one of the first online financial shows, basically. And it was a show called Finance Vision, if I can remember. I think it was Yahoo Finance Vision, if I remember correctly. Yeah. And Charles Payne was one of these new talents. I don't think, if it wasn't his first job, it was a very early job in his financial journalism career. And it's been great to see, what's happened with him over time. Finance Vision didn't last for very long. It was replaced by a few years later by another similar financial media show that Yahoo was doing called Yahoo Finance Tech Ticker, and it was chaired by Henry Blodgett.
Yep.
And then Henry,
I did that with Henry. Yeah.
Okay, yes, you remember doing that with Henry, and then Henry went on to found Business Insider, right, which became a really, popular online financial media site.
Of course, you also have to remember though that he got banned from the industry because of his calls during 1999, 2000. He got banned from the financial industry, which is why he went to start Business Insider.
Exactly, and my business school roommate actually was working for Henry at that time when that all went down. So it was crazy.
Nice guy. Nice guy, by the way.
Very nice guy. Very smart guy. Only, nice things to say about him. I don't know a ton about exactly what went down for those trades, but I have heard him address all questions very openly and honestly.
Oh, yeah. No, he, unfortunately, and this always happens, in the financial industry, is that, and in 1999 was really no exception to 2007, even early 2008, he was the analyst for Wall Street, and everybody was out pumping every stock out there, right? I mean, whether it's SDLI or JDC, all these stocks are going to the moon, because as I've showed you before, when Wall Street, looks at what's important to them, the retail guy is at the very bottom of the list. This is about investment banking. This is about relationships with these big companies so they can make revenue. And he was just doing his job as an analyst. But, when everything fell apart, the SEC starts looking for, who's the guy that we're going to put a noose around. And Henry Blodgett was one of the rising stars of the industry at that time. And, there was 50 other guys right behind him doing exactly the same thing. Unfortunately, he just, he got the axe.
Yeah. And now that I'm kind of remembering, I think one of the things that got him where evidence was in an email or two internal, he had written something like, I have no idea how this company is worth as much as it is. Like, this is bananas, right? And of course, it was bananas, and it was in an unprecedented time where valuations got stretched to a point where they had never gotten to, especially for companies that weren't making any profits nor might not make any profits, right? And so they sort of held that up as like, how could you be recommending a stock publicly when you were saying internally, like, I just don't understand all this stuff, right? But as you said, everybody was doing it at the time.
It was. And look, and if you didn't do it, you were out of a job. There were plenty of emails back in 1999, 2000, where analysts would come out and make recommendations under basically the threat of losing their job. In fact, there was one analyst, I can't remember his name off the top of my head, but he was a big guy back in the late 90s. He came out and started saying, these stocks, he told the truth, these stocks are overvalued. You should own them. The guy got death threats from investors. Literally, I mean, I'm not talking about, you just shut the hell up. I mean, literally, people were threatening to kill this guy because he was speaking the truth about what was going on in the markets. Nobody wanted to hear this. Nobody wanted to hear the truth. They just wanted the bubble to last forever. But, we see this every time. And then, of course, as is always the case, the SEC promotes and supports this stuff until it blows up. And then they come in and they come in like the cowboy with the white hat, and we're going to, you're the sheriff. We're going to clean up the town now. And it's like, well, great. You missed Enron, you missed WorldCom, you missed Lucent, you missed, Global Crossing, you missed the financial crisis. Good job, fellas.
Right.
It's like,
they need their headline. They need to find their scapegoat. Yeah.
All right. Now you got me on a whole rampage here. So
no, it's just super interesting to go back through that history there, right? And it's instructive because like in AI right now, we're back in a mania in AI at least, right? So you get to keep that context in mind, that perspective in mind. So last point on this, and then we'll end up, folks. But platforms like this, I think are hopefully, sort of part of the future of where things are headed in media. Good for us. We'll pat ourselves on the back and have a little humble brag moment here. But more important, we're continuing to always say, look, well, how do we make this better, right? How do we better serve the needs of our viewers? And I just want to put an idea out there, Lance, I hope it's okay with you, because we were kind of spitballing this a little bit last time, is I've long said, look, there's only so much commentary that we can create in a given week on one channel here at Wealthion, right? So Wealthion is mostly a macro channel, right? It's mostly hey, here are the trends that are most likely to impact the economy and the markets going forward, right? We try to give as much market commentary as we can. And Lance, the main vehicle for that is these Saturday weekly market recaps that you and I do. But there's only so much that we can pack into an hour and a half-ish or so. And there's a lot that goes on every day in the markets that folks who are really intently interested in the markets, would love for us to dig into. We just don't have the time, and we literally don't have the space in a given week, since we're already doing 5 to 6 videos a week on this channel, to do. So one of the ideas that we're kicking around at this point in time is creating a new channel, a markets channel, right? Where there'd be lots of other commentary in there. Okay, what did the market do instead of what did the market do this week and why did it matter? What are the markets likely to do today? Okay, what do the markets do today? What were the big, action driving headlines? What are the implications of them? Hey, on a weekly basis, which companies look, most undervalued? What are kind of the best bets here that we should be looking at? Oh, what news just came out today, or what did the Fed say today that's most likely to impact markets going forward? I mean, there basically is a zillion different other topics that we could be talking about related more to just market action. And look, not everybody is super interested in the markets, and so they don't have to watch that channel. But for those that are, we could be serving them much more fair than we're able to on the existing Wealthion channel. So Lance, I'll let you give your 2 cents in just a second. But folks, if this is something that might be of interest to you, or if there's other types of information, insights, et cetera, you'd like to see brought to you by Wealthion in some shape or form on this channel, on a new one we create, let us know in the comments section below. We'll definitely be listening to this. But because Lance and I are beginning to kind of ideate on what this could look like, I just wanted to put up a trial balloon here amongst you, the audience, that we could start getting your input. Lance, anything you want to say to that?
No, I think it'd be interesting. Again, the problem is, as you said earlier, is that, CNBC is great. Problem is that you get a bunch of paid advertising. Most of the people you hear on CNBC are paying to be there, or they're a big sponsor. It's a big mutual fund company, whatever it is, that buys ads and those type of things. So you don't always get kind of the real kind of unbiased truth. So I think a channel where
no matter what happens, it's always a great time to buy stocks because they're getting paid to say that, right? Yeah,
exactly. So, I mean, could you imagine a channel where you had a technical analyst that was on there saying, hey, we're really overbought here, and probably over the next week or so, we're going to have, some risk here. So you may want to take some chips off the table, right? I mean, imagine hearing that on CNBC. That would never happen.
Because he'd never be invited back on. Yeah,
exactly. So, and again, maybe you have like a bull bear segment where you have a bull guy and a bear guy and they debate it off. I mean, there's so many things that you could do to be really informative. In a 30 minutes or an hour once a day, I think it'd be fantastic.
We could televise, if you're comfortable. I don't want to speak for you, but we could literally televise your portfolio meetings with Michael, where you guys are just going through, hey, these are the allegation decisions we're going to make. Let's argue. What are we going to end up deciding here? I mean, there's a zillion things we could do.
Yeah, no, absolutely. And I think there's so many good people out there in terms of, other, financial analysts and financial investors and professional investors that, you could do a whole lot with a channel that I think would really help people figure out how to manage their money better. And then you could create a whole nother channel just on financial planning, because that's a whole nother bailiwick.
Already on the radar.
Yeah. I mean, just stuff that people need to understand about how to manage their money better.
Yeah. And, today I asked you your opinion of Michael Pento's outlook there on US Treasuries. We could have had you and Pento here talking about it yourselves, right? I mean, we again, there's so many things we could be doing with this medium. All right, well, look, we'll leave it there. Folks, just in wrapping up, I want to remind everybody that tickets for Wealthion's online fall conference are still at sale at the early bird price of nearly 30% off. So if you haven't yet gone and registered for it, do so soon to lock that lowest price in. And of course, if you're an alumnus of our previous conferences, check your email. You'll have a code from me to get an additional 15% discount off of that 30% discount that I mentioned. But I can't remember exactly when that expires, but it is coming up. So act soon. As we say always every week, there's a lot of uncertainty and a lot of decisions that the average person needs to take into account in deciding how to navigate their wealth through what may be coming, whether it's a run up to the end of this year or whether it's something surprising in the markets that get those people that are, saying, look, we could crack below key support. Who knows? But the point is you should be working with a professional financial advisor who can guide you through all this, create a personalized, bespoke financial plan for your portfolio, and implement that plan for you while keeping you well informed. There really aren't that many out there that do that in a way that takes into account all the macro issues that Lance and I talked about here. But if you have a good one who's doing that for you, you should stick with them. But if you don't, or if you'd like a second opinion from one who does, maybe even Lance and his team there at Real Investment Advice, then highly recommend that you talk to one of the financial advisors that Wealthion endorses. And to set up a free consultation with them, just fill out the short form at wealthion.com. Only takes you a couple seconds to fill out that form. Consultations are totally free. There's no commitment to work with these advisors. It's just a public service they offer to help as many people as possible position as prudently as possible today. Lance, it's been wonderful, my buddy. Folks watching, if you enjoy seeing Lance and I go toe-to-toe every week, mano a mano like this, do us a favor, show us your support for this program by hitting the like button, then clicking on the red subscribe button below. As usual, Lance, you get the last word for the week.
Look, have a great weekend. I have no idea what's going to happen next week, but the Fed meeting will be key for that, and we'll talk about it next Saturday.
All right. Look forward to talking about that with you next Saturday, Lance. Everyone else, thanks so much for watching.